Morning, everyone. Thanks for joining us today for the John Lewis Partnership full year results for 2023-2024. There's going to be a short presentation and then we'll have plenty of time for Q&A, and I'll hand over to Sharon White.
Thanks, Chris. Morning, everyone. I'm Sharon White, Chairman of the John Lewis Partnership. I'm here with Nish Kankiwala, whom some of you will remember joined us as Chief Executive almost a year to the day. Bérangère Michel, who is our Finance Director. James Bailey, who heads Waitrose. And Naomi Simcock, who is Operations Director at John Lewis. You'll know that Peter Ruiz recently came back to the partnership as head of John Lewis. He's traveling today and having some connectivity issues. And so Naomi is going to be stepping in with any questions you have on the John Lewis front this morning. I'm going to start off with a bit of an overview before handing on to Nish, who's going to talk about the strategy and the partnership plan refresh. You'll have seen, hopefully, from this morning's announcement that the partnership has returned to profit, and we're expecting profitability to grow again this year. Profits are up, debt is down, and the balance sheet is stronger. The plan is working and we are making progress. We're not complacent. We recognise that we are still some way along the journey, but the hard work of the past year has generated the cash that now allows the partnership to invest for growth. The hard work, I have to say, is a real tribute to partners, 76,000 partners across the business. And the profit improvement has been driven by a combination of working more simply and flexibly and by growing customer numbers over the past year. And indeed, an extra 1 million customers are shopping with us today as compared to a year ago. In the coming year, we're going to be investing more than £500 million. That's an increase of 70% compared to last year. 75% of that is going to be in our 2 retail brands. We're also investing a record amount in pay, £116 million. As a partnership, we're able to focus on the long term, which is why we're able to invest our cash in growing the business and in pay rather than paying a bonus this year. The team is going to talk more about where we'll be investing precisely, including opening the first new Waitrose stores for the first time in 6 years, investing in both brands, improving customer service and technology. We're also continuing to develop a family of businesses, financial services and build to rent, which support the long-term profitability of the partnership. The partnership is a unique business, the largest employee-owned business in the UK and in the world. And it's that model that will fuel and power our continued recovery. Nish?
Thanks very much, Sharon. My first year as CEO, I'm pleased to announce an improved set of results for the partnership delivered by our amazing hardworking partners, whom I actually want to thank very much so. Our strategy is unashamedly focused on retail. That will deliver long-term sustainable platform for achieving our purpose, unleashing the potential of our much-loved brands, John Lewis and Waitrose, whilst building longer-term financial services and build-to-rent lines of businesses. We've completed the first phase of our strategy by returning to profit, growing customer numbers, and leveraging better cash flow to invest. Looking forward then, we shall build the foundations for growth by 4 key drivers, and let me take you through them in summary. Firstly, energizing our unique customer offer to drive growth. For Waitrose, we'll build on our passion for great quality tasting food, ethical standards, whilst enhancing even further our service delivery. For John Lewis, we'll build on our strength as an omni-channel retailer, differentiating on product design, quality, curation, and brilliant service. We'll also launch our Pan Partnership loyalty program that will build on the trust and lifetime value of our customers that shop our brands. Secondly, delivering inspired service by our amazing partners. The service our partners, as owners, provide will be central to our retail strategy, relying on their trust, product, and customer knowledge. To reinforce this strength, we'll accelerate and invest in our training and capability plans for our partners. Additionally, we'll simplify our shop processes to enhance the amount of time our partners get to spend with customers. Thirdly, we need to modernize our retail infrastructure. Therefore, we'll accelerate our investment in technology, underpinned by a Google cloud-based infrastructure and improving our customer-facing solutions, such as faster shop Wi-Fi and mobile ticketing for shop partners. We'll also modernize our shop estate with over 80 Waitrose shops being refurbished, while significantly enhancing our proposition in all John Lewis shops. We'll invest in the supply chain across both brands and ensure our systems and technology are upgraded significantly to support our growth plans. And fourthly, we'll have significant investment fueled by productivity by simplifying our work. We will invest over £2.4 billion over the next 4 years, funded by internally generated cash flow. We'll simplify our work, enhance customer service, and reduce costs, such as use of robotics in the supply chain, enhancing our real-time stock data to improve stock availability, and making returns simpler for customers. So this strategy focus has improved last year's performance, for which I will give the key headlines and the team will elaborate the details in their presentation. So overall, our partnership sales went up 1%. This reflects our focus on improving our customer offer and particularly on quality and value. We've had a very strong customer response with 1 million additional customers. In Waitrose, sales were up 5%, driven by new customers, investment in value, innovation, and growth in convenience channels. In John Lewis, down 4%, which is a solid outcome in the context of a challenging market. Fashion, including beauty, was up on the year, in part due to over 100 exciting new brand launches. Higher sales, together with margin improvement and improved productivity, all contributed to a return to profit, which improved by £120 million versus last year to £42 million. Operating margin, profit as a percentage of our revenue, which is a measure of our productivity, improved by 119 basis points. Trading operating profit improved for both brands, Waitrose by 19% and John Lewis by 2%. This overall improved performance has critically led to higher cash generation, which is a key focus of our future strategy. This will fund our investments in building this foundation for growth. The net cash generated last year was £433 million, which was an improvement of £201 million versus last year, which was an increase of 87%. Our debt ratio improved, underlining a strong balance sheet. And finally, this overall improvement in our performances allowed us to invest £116 million in pay. This means that approximately 2/3 of our partners will get an approximately 10% pay increase. I'll now hand over to Bay to cover the financial information.
Thank you, Nish, and good morning all. So I'm very pleased to report significantly improved financials for the last financial year on the back of a challenging set of results in 2022. So in the full financial year to the end of January 2024, we've delivered improved profitability, improved productivity, and improved liquidity. The partnership made a profit before tax and exceptional cost of 42 million, which is a £120 million increase on the prior year. And including exceptional income of 14 million, profits before tax for the year were 56 million, which is an increase of 291 million pounds compared to a 234 million pound loss in 2022. So whether before or after exceptional items, our results show that the partnership has returned to profit. We're introducing a new key financial measure this year, as Nish has mentioned, to measure total productivity, which is operating margin as a percentage of revenue, It was 1.2%, up 119 basis points year on year. Increasing profitability drove better cash generation, and in turn that improved our debt ratio from 4.4 times to 3.4 times. And I'll now unpack all of this for you, starting with profit. The improvement in our profit before exceptionals is driven by both trading and productivity. Partnership sales were up 1% to £12.4 billion, which increased our profit by £64 million year on year. Gross margin rate also increased, and that contributed another £62 million to our profit recovery. And this reflects our continued progress with reviewing our assortments and supplier contracts, and also reduced freight costs. We also delivered £88 million of operating cost savings, principally through better matching partner hours to customer and business need in Waitrose shops, a reduction in energy usage, automation of the John Lewis supply chain, and continuing to review spend on goods not for resale, such as technology and carriers. So in total, across the partnership, across gross margin and operating costs, we've delivered £111 million of efficiencies in a way that also benefits customers, and that's key. So for example, following technological investment in stock management processes, product availability has gone up in both John Lewis and Waitrose, and achieving record levels in Waitrose. And that takes recurring productivity savings since the start of the partnership plan 3 years ago to £420 million, and we're on track to meet the £900 million target that we've previously talked about. We continue to see the impact of inflation, but it has softened. It's driving increased costs of £112 million year on year. The key contributors are pay and utility costs, and we expect these pressures to continue in 2024. So overall, we've returned to profits through the structured execution of our plan. Hence, we believe the improvement in our financial metrics to be sustainable. And we now need to focus on boosting that profit even more through investing in growth. So let's talk about cash. The improved profit is behind a material step up in net cash operations, up 201 million year on year to 433 million. And we invested 312 million pounds of that in 2023, of which over 95% was in Waitrose and John Lewis, with the remainder in financial services and building rental homes. In 2024, we plan to step up investment by 70% to 542 million to accelerate our growth, and we will focus on modernizing our technology and refreshing our shops to enhance customer experience and on simplifying how we work. In addition to improving our own cash generation, we raised £260 million of new funding last December through the sale and leaseback of 11 Waitrose shops alongside a new term loan. From here onwards, our plan assumes we will be self-funded. So what does that mean for debt? So last year, I told you we had historically low levels of debt. In 2023, we have paid back a further £50 million loans, and we've raised 126 million through the new term loan I've just mentioned. So that brings total borrowings to 733 million. This is a temporary position. We have a £300 million bond due for repayment in January, and we will use our substantial cash reserves to pay off that bond, bringing borrowing back down to the lowest levels in decades for the partnership. Our total liquidity at year-end was 1.7 billion. That includes 420 million pounds of a new credit facility. So overall, on cash, we have the funds to deliver the plan and to fuel the partnership's growth. And I'll now hand over to James to talk about Waitrose.
Thanks, Bay. Good morning, everyone. So headlines for Waitrose: sales were up 5% year on year. We had record customer numbers, and we made £170 million profit improvement year on year. So in customers, as I say, a record year for customer numbers. More than 1 million new customers chose to shop with us last year, and more still from our new partnerships with Uber and Dobbies. That's our 8th quarter of customer growth. And as consumer confidence recovers, we see significant opportunities for future growth for the brand. And that growth comes because we are delivering what matters to our customers. On service, we had a record number of gross of 33 wins, and we've seen a noticeable further improvement in customer satisfaction since we've implemented our new shop processes through the second half of the year. On value, we've invested £100 million in price last year, and we saw volume and customer numbers react to that investment. And we've also introduced new and very popular meal deals. So, for example, our £5 sandwich meal deal, more than 200,000 customers a week now choose to shop with us on that basis. And within our supply chain, Our supply chain system upgrade is substantially complete now, and we exited the year with record product availability. As I said, we've also made material progress on our underlying profitability. So our trading operating profit improved by £171 million, and that's 170 basis points year on year. And that is despite the £100 million investment in price I mentioned. That step change is driven by the early results of our productivity strategy. For example, renegotiating improved long-term deals with our key suppliers and redesigning our store processes and investing in technology. But this is the beginning of our journey on reshaping a more efficient and fast-moving Waitrose. And looking ahead, we still see significant further opportunities. And I'm delighted to say that this strong and improving cash flow means we can now kickstart a record investment plan. We will be investing in product quality, innovation and price, and potentially as importantly, we'll be spending nearly £1 billion renewing our shops for our customers. And I'm really excited to confirm that for the first time for nearly a decade, we're developing a pipeline of new Waitrose shops. So in summary, we exit the year with significant hard-earned momentum and confidence for the years ahead. And on that, I'll hand you over to Peter.
Good morning, everyone. Hopefully you can hear me. Apologies, a few connectivity issues, so there may be some background noise. But before I start, I should take the opportunity to say hello to everyone on the call. Looking forward to seeing you again soon. I'm only 8 weeks in, so still getting my feet under the desk. And I should say everyone's first question is, why are you back? And the simple answer for me is there's honestly so much opportunity. This is an incredible brand, and I genuinely believe we're uniquely positioned to drive future growth. If I move on to a quick summary of the highlights for the financial year. As you know, John Lewis delivered an improvement on profitability. We attracted a third of the UK population, 13.4 million customers, a 300,000 gain on last year, which of course speaks to the strength of our much loved brand. We saw improved productivity through better optimization of our supply chain network, good cost control and sourcing enhancements. And we saw a great gross margin increase of 100 basis points. The standout areas were beauty and fashion. Beauty had its biggest year ever at 480 million, plus 18 million, 4% on last year, and menswear grew at 3%. We saw continued investment in partnership with our suppliers with 480 supplier investments in our stores. However, it's very clear we continue to trade in a dynamic and volatile market with significant cost pressures. Customers are still cautious about discretionary spend, in particular within home. But the transformation plan is showing good progress, and I'm honestly really confident we can grow this year from a more solid base. If I pick up on the points on the slide, firstly, we retain our unique omni-channel presence. 53% of our customers use our digital channels for their shopping, underlying the importance of our omni-channel offer, with app usage a growing component of sales. We made it quicker and easier to shop online for delivery or collection, and now have over 13,000 locations. Secondly, we're partnering with our third parties and simplifying our operations. We've seen continued growth of third parties. We launched the Floor Room this year and Randox Health Clinics, and we're working with key hospitality partners such as Ori and Benugo. And as mentioned above, we saw a number of productivity initiatives. Thirdly, we're investing in key categories within our own brand and branded offer. Own brand fashion had a fantastic year as we sharpened our focus on fit, style, introduced premium fabrics. Men's and women's own brand moved sales forward by 3%. We introduced 100 new fashion brands such as Equipment and Vivier, and beauty sales rose as we introduced new brands. Sol de Janeiro has only just launched, and we had record years with some of our existing brands. Charlotte Tilbury, Tom Ford both grew double digit. Finally, we're giving customers more reasons to shop with us. Growth of all of our advisory services with strong demand for our partners to assist with personal styling. We saw those appointments up by 27%. Nursery consultations were up by 25%, and home consultations were up by 5%. We increased customer loyalty with 900,000 more MyJL members through better personalized offers and unique benefits. We launched interest-bearing credit to help customers spread the cost of purchases. And we continue to actively price match against all our competitors to ensure we are really good value for money. Moving forward, we'll invest in 160 new shop enhancements in partnership with our suppliers. That's just in half one. There'll be around 80 new brands planned to launch in 2024. We'll continue to support our service proposition through new technology. We're just launching headsets across our selling team. And we continue to improve our online experience with strong investment, looking to get easier navigation, personalized product recommendations, and with significant investments across our digital stack to achieve that. On that note, I'll pass you back to Nish.
Thanks very much, Peter. And before I open up for questions, let's just conclude. So a good performance in the year. We're back into profit and getting ready for a significant investment in growth. Our strategy is about building a foundation for growth focused on our high potential, much loved brands, whilst continue to bring to light our financial services and BTR lines of business for the long run. The investment for growth is fueled by our own cash generation, by growth, and by simplifying how we work. This will result in a thriving, long-term, sustainable partnership for the future. And with that, I'm going to hand back to Chris.
Thanks, Nish. And we've now got time for questions, everybody. So if you could online, just put your hand up and we'll come to you. If you can just say who you are and which organization you're calling from. I think that's a record. We've never not had any questions, but oh, now we've got a few coming up. Could we Dimitris, if you could take yourself off mute and just say which organization you're calling from.
Can you hear me now?
Yes, we can hear you now.
Oh, perfect. Yeah, thank you so much. Yeah, thanks for the presentation, and yeah, congratulations on a good set of results. I had two questions, if I may. So my first one is, I just wanted to confirm that the 201 million improvement to the cash flow that you cite, that includes or excludes the sale and leaseback transaction?
Let's answer that one first, Bay, if you would.
So, hi there, Dimitris. So the net cash from operation improvement of 201 million is just cash from our operations. So it includes it excludes capex. It also includes funding. Our liquidity is up 239 million pound year on year, including that funding, which we're very happy to have secured to enable us to boost our investment in growth.
Okay, so sorry, just to double check. So that 201 million excludes the sale and leaseback, right?
That's correct, yeah.
Okay, so if I take the movement in cash, then how do I reconcile the two? Because you had 201 from operations, and then you had another 260 coming in from sale and leaseback.
Yeah, sure.
I would have expected a bigger movement in cash.
Yeah.
Am I missing something?
Yeah, so net cash from operation at 433, we invested 312 million pound of that last year in investment. There's a few other movements like interest and the like, and then you add the financing at 260, and you get back to where you ought to. Very happy to walk you through that separately as well if it's helpful.
No, that's very clear. Thank you. And then you are guiding for capex to increase by around 70%.
Yeah, for investment to increase by 70%. Yeah.
Okay.
So we're going to 542 million next year investment to on the back of our cash generation in order to accelerate and step up our growth now that we've turned a corner.
Okay, and you did mention at the beginning that you expect profitability to keep improving. I just wanted to understand in the context of investment also going up by 70%, and you have some working capital initiatives, I understand as well. If we combine everything together, what's your view roughly on how cash flow should evolve next year?
Yeah, so we expect all of our key financial metrics to improve year on year because we've got a plan and we're executing it step by step, and so far it's on track. So three key measures are profit before exceptionals, operating margin as a measure of productivity, and debt ratio. These are the three. So yes, we expect our our cash to continue to increase. Just to watch out on that. As I said, at the end of the year, we will repay a bond using our cash reserves. So you'll see the cash go down for that, but so will the borrowings. So the financial health of the partnership should continue to improve.
Okay. And my final question was on the John Lewis banner. There is a lot of work going on, which is showing up in the numbers. I just wanted to understand the small improvement in the actual level of profit that we have seen in John Lewis at the group level. Most of it came from the Waitrose banner. How should we think about that number? Is it lots of work in productivity and cost savings offsetting volume decline? Is that a fair assumption?
I'll kick us off, and Peter, if you want to add. So we've seen trading operating profit for John Lewis improve. Trading operating profit is gross margin, take out operating costs like selling costs, marketing, and the like. And the way we've achieved our profits, so it's a combination of gross margin rate improvement, which Peter mentioned, 100 basis points, significant gross margin rate improvement, the reflection of the work we've done as part of our productivity agenda on assortment and also reduced freight costs. And then secondly, we've also reduced operating costs and we're on track with a £900 million saving that we've been mentioning before. That's across both Waitrose and John Lewis. So what you see in John Lewis effectively is that the improvement in gross margin rate and in productivity has boosted the profit of John Lewis despite sales being down. Peter, would you like to add to bring up color on that?
I think that covers it, Bay. As you heard, some decent growth in fashion, which comes at higher margin, strong discipline across the piece, really clear that we need to improve home sales, but lots of plans to achieve that. But yeah, it was more than cost savings. It was a very, very disciplined performance across the year with some strong, I suppose, early shoots of opportunity to grow into this year.
Okay, very clear. And my final question is,
can we just one more, Dimitri? Thanks.
Yes, that's my final, I promise. Do you tend to get a rating on your bond?
So, sorry, Spay again. I presume this one is for me. So, our bonds are not rated, and that's why when we present results like today, we talk about debt ratio as kind of a metric of financial health, which has improved to 3.4 times. And as a result of that, you'll see our bond trade are slightly a premium because of their liquidity, but our bond spreads have gone down. Both are two bonds, which is a sign of the improving performance of the John Lewis partnership.
Yeah, definitely. I think it will help, open up the audience to your bonds if you get a rating. But yeah, I would leave that with you to decide.
Thank you.
Thank you so much. Thank you.
Thank Dimitris.
Thanks for your questions, Dimitris. Next up, we have John Ryan from News Stores. If you could just unmute yourself, John, and ask your question.
Yeah, morning. Can you all hear me?
Yes. Hi, John.
Hello. James, question for you. You mentioned that there's a new store pipeline for Waitrose. Can we know where they might be? And equally, within that pipeline, is there the downside of potential store closures anywhere as well?
Morning, John. No, you can't know where they are. We're still working on it, but we're not far off now. We'll start announcing customers and partners first, and then obviously everyone will know hopefully in the next few months, we'll start to see that pipeline come through.
Yeah.
But all of the work we've done suggests there's plenty of room out there and lots of demand for those new Waitrose shops. So we're quite excited to get on with that. And what was your second question? Sorry. Oh, closures. Yes.
Yeah,
No,
closures.
at the moment. There's the usual question of renewing leases as they come due, but we've got no plans to close any of the Waitrose shops we've got at the moment, but we keep those under review all the time.
Okay, and if I may, one other question, not for you, James, but for you, Peter. You mentioned, or Nish mentioned, that there'd be a radical investment in the store proposition, and obviously the floor room has gone in over the past 12 months. Will there be other things like the floor room going in?
Hi, John. Good to hear from you.
Hi.
We're looking at all sorts of plans across propositions. So nothing I could call out specifically, but lots and lots of changes. I mean, I think what the specific would be more hospitality. So we've called out Benugo and Ori, and there's other partners joining us across the year. So bringing a broader hospitality offer to our stores. And then we're looking at really opportunities across everything we sell in terms of bringing new investments in. So yeah, so watch this space, more to come.
Okay, that's it. Thanks very much.
Thanks, John. Next up, we have Patrick O'Brien from Global Data. Patrick, if you just want to unmute yourself and we'll get your question.
Okay, thank you. I just noticed that you haven't split out the sales of fashion, home and technology in the John Lewis department store sales as you usually do. I don't know if I missed it in the presentation, apologies, but will you be splitting out that? And if not, can you give some indication of the relative merits of home and technology?
Peter, would you like to pick that one up?
I don't know if it's best for Bay to talk to it in terms of whether we want to bring out the specifics.
Okay. So what we've seen is that we've actually had a record year in fashion, actually. But what we're seeing is that customers are spending more on themselves and their family, so fashion, beauty, than on their homes, like home and tech. So and what you're seeing in terms of the spread of sales of John Lewis, it's about a third, but now fashion is actually a bit bigger. So if you look at the total numbers and go like that, so good performance in fashion and a more challenged performance in home and tech. As you would
home and
expect.
tech, yes, but in home and tech, between the two, where have you suffered the most? Is it home and tech, and what's the outlook for that?
We are actually continuing to attract more customers in John Lewis across all of our categories. What we're seeing is the little thing that brings sparkle to your home selling more than the bigger sofa and the bigger investment. And that's why we've done things like introducing interest-bearing credit to help our customers split those purchases.
So which category performed the worst, home or technology?
Go for it, Peter.
So I can talk a bit more about the future. You know, we don't want to pull out the specifics because there's a lot of competitive tension around that. But I see considerable opportunity for both technology and home. I think it was a challenging market last year around big ticket for obvious reasons with the inflation. But there's so much change, so many initiatives in home, a lot of new technology coming through at the moment. We've had an amazing few weeks with Apple as they've launched new products. So I see significant opportunity for both. I do not see those as diminishing markets for John Lewis.
Okay, thank you.
Thanks, Patrick. Next up, we have Opie Farrenloy. Opie, could you go ahead and ask your question, please?
Hi there. Can you hear me, please?
Yes, we can. Hi there.
Thank you. So I'm Ope Farinloe calling from Allianz Trade. Of course, the question I have is related to, you mentioned one of the new metrics of productivity, and that's the operating profit to the ratio of the revenue. I just wanted to find out, is this a metric that's internally set, or is it a requirement linked to debt?
Come back. I'll pick that up if that's okay. Yeah. So productivity is a key part of our plan, and we announced a £900 million target for which we're on track to achieve at 420 million. But we're mindful that an absolute number perhaps doesn't talk as much as total results. So that's why we're introducing this measure. So it's entirely our choice. We have no obligation to do so, and it's as part of refreshing our plan and focusing on execution. We've developed a scorecard of measures, as you would expect, so targets from the board to our shops, and productivity measured through operating profit as a percentage of revenue is one of these metrics. So it's about our own self-discipline in execution rather than anything else.
Thank you very much.
Thanks for the question. And next up, we have a question from Farhad Maloo from Jefferies. If you want to unmute Farhad and ask your question.
Hey, thanks for the presentation today. Yeah, I mean, I have a couple of questions. First one is, where do you think these results fit within your turnaround plan? Obviously, you extended it in H1 from 2026 to 2028, I believe. So where do these fit within that, given that you returned to profitability in particular? Second, how much of your increased investment plan for next year is on property development? And sorry, the third one is, where next year, where do you see the margin improvements coming from, with over 100 million spent on increased wage costs and also the higher investment plans? Thank you.
So, Sharon, do you want to take the first one?
Yeah, morning. And just great to say hi. Nish and I are going to sort of pick this up between us. You'll remember at the half year we said that because of the tsunami of inflation and everything that was happening in the external environment, we were extending the plan by 2 years. That's confirmed. We haven't given an update on that because the 2-year extension that we talked about at half year is unchanged. Really to say, obviously, what today is showing is that the plan is working. So our objectives in terms of reaching our target profit, obviously returning to profit to this year, but that will build improving profit this year and step by step through to the end of the plan is unchanged.
Thanks, Sharon. I'll hand over to Farhad in terms of property. I mean, in terms of where are we in the journey, I think we are at the place where the first phase of our plan is actually complete, which is we've returned to profit. And we've returned to profit in a sustainable manner. We've grown customer numbers, we've grown top line, we've improved the way we work, we've improved margin, and we've improved cash flow. So I feel really quite positive about the quality of earnings that we've delivered in terms of that sustainable profit. And that's exactly the algorithm we're going to use for the coming 3 or 4 years, Farhad, in terms of, again, growth, simplicity, investment fuels growth, simplicity, and investment. And that's why I think we feel very, very optimistic about reaching the targets that we shared at half year. But in terms of property, Bay, if you wouldn't mind.
I'll cover property and the profit improvement, starting with the latter, if that's okay, just better flow to your point, Nish. So we've returned to profit and we've achieved this structurally. So that profit improvement, we believe, is sustainable. And we'll continue building on it towards our target of £400 million at the end of the plan. And in 2024, we expect a profit to continue to improve because on a trading basis, our customer numbers are up almost 1 million, and effectively customer numbers is latent sales. Now, of course, it depends on what happens to the consumer sentiment and the like, and we want to be there for our customers for the long term. But nevertheless, that gives us comfort. Secondly, we've seen significantly improving trends in volume in Waitrose throughout the year. So we've ended the year much better than we started the year, and that flows through in 2024 with a continuation of improvement in Waitrose. And thirdly, we're on track with our productivity program. And what that means is that some of the changes we implemented partway through the year, so if you think, for example, a review of an assortment or supply negotiation or change, only had a part-year effect in 2023, but has a full-year effect in 2024. So these three things give us confidence about the improvement in our profit, together with the fact that we have a sequenced, clear plan and priorities. But of course, the economy will be what the economy is, and so we are cautiously optimistic. With regard to property developments, I presume you mean build to rent. So just to confirm, over 95% of our investments is in retail, and over 95% of the growth in our plan is in retail, and the two match for good reason. We are committed to building rental homes, and we are in the process of planning application. The funding for the development is not from us, it comes from our third party, Aberdeen. So it's not for us to put in. We put in our property, we put in our brand, we put in the operation in time, and they put in the money, and then together we build homes that are much needed in the UK.
Thanks. Does that answer your questions, Farhad?
Yeah, sorry, the final one though, just on the margin improvements. So where do you see the margin improvements coming from with next year with 100 million increased wage costs and the higher investment plans? Maybe you touched upon it.
Yeah, so well, as I mentioned, is we're seeing that through the continuation of our productivity agenda. We're seeing that because of volume trends in Waitrose, and we're seeing that because we've got growing customers, which are latent sales. So we've achieved sustainable improvements that will carry forward into 2024.
Okay, so it's just continuation of the trends that you had in H2, basically.
And continuations of the plan that we set out to achieve, yes.
Okay, perfect. Thank you.
Thanks, Fahad. That concludes today's questions. Thank you all for attending the call, and thank you for your questions. Oh, actually, sorry, we have one more. Stephen Clapham would like to squeeze in a last question. Stephen, we'll just unmute you, and if you could go ahead.
Yeah, actually, I wanted to ask two last questions, if I may, please. The first is for the CFO. I was just trying to understand, the net debt is up, the profits are up, the CapEx is down. You've got sale and leaseback, it's like 100 million more than the increase in the pension deficit. I just couldn't quite figure out why that is.
So your question, nice to talk to you again, by the way. I'm not surprised about a balance sheet and cash question from you. So so your point is what's happening to total net debt and how's it changed? Is that what you'd like to? Yeah. So total net debt is about 1.7 billion. Some of that is leases that hasn't changed. Some of that is accounting pension deficit that has increased, but on an accounting basis. Our triennial valuation concluded last summer, as you know, and we don't have any cash deficit repairs. Our cash position has improved, but our borrowings are up, but only temporarily. So they'll go back down next year, but so will the cash as we pay it. So our total net debt position is at 1.7 billion. I would say nothing to report, really. Does that work? Does that make sense?
Well, I'm a bit slow, you know, so.
No, you're not.
You've got higher profits, lower CapEx. You've done a sale and leaseback for 260, which is 100 million higher than the increase in the pension deficit. So and the lease liabilities are pretty flat. So I just don't understand why your debt hasn't fallen. Because I would have expected it fallen by a couple 100 million. I mean, just doing it in the back of a cigarette packet, but.
So I think it's because the number that we presented on the slide is borrowings rather than total net debt. Actually, that's why. So it's really just proper loans. So and they've gone up, yeah.
I'll wait for that counts rather than boring everybody, because I know you want to get away. And I have a question for the CEO.
No, I don't. I'm here for the whole day.
All right. Okay. Well, maybe we can figure this out later. A question for the CEO. I just wondered if you had any reflections on managing a retailer for the first time and how different it was from your previous roles, and were there any surprises you've encountered in your first year?
Good to meet you on the call, Jeff. I mean, I obviously ran a Burger King business, which was 4,000 restaurants not that many years ago in terms of retail business. But I mean, I guess in terms of reflections, I think two things. One is the partnership has got some fantastic opportunities ahead of it. And in my first year, it is just very pleasing to see that 1 million more customers have come through our shops, that we've returned to profit. We've invested a record amount in pay, and we're going to invest a record amount in growing our business for the next year. So I think my first reflection, Jeff, is those opportunities are really there. And secondly, I think the thing that I really found fascinating is that our partners are really our edge, Steve. And I think that is something that we will continue to leverage going forward in terms of our partner difference.
Thank you.
Great. Thank you very much. That definitely does conclude all our questions. We're going to leave you with a short video about what our customers think about the John Lewis partnership. And as you heard, we added 1 million extra customers this year. So we'll leave you with a video. And if there's any other follow-ups, please do get in touch with the team. Thank you all today.